Okay, so you want to quickly understand the story behind a key stock.
Yeah, let's do it.
Let's dive straight into Caterpillar, CET,
Big one.
definitely. So our mission is, well, pretty simple. What are the crucial takeaways? What do you need to know about Caterpillar's present and, its future?
It's interesting, isn't it? Unpacking how a foundational industrial player like Caterpillar is navigating today's, well, complex economic landscape
Yeah,
and how they're adapting their strategy. It's like way more than just bulldozers.
absolutely. It's a global enterprise in motion.
Mm.
Okay, so the stock. Currently at $342.55.
Okay.
That's after a solid 5.2% jump just yesterday.
Decent one-day move.
Yeah. And the fair value estimate, according to the report, is around $337.42.
So trading pretty close to fair value then.
Seems like it, yeah.
Oh.
Over the past year, it's been between $267.30 and $418.50. Quite a range.
Big swings. Market cap.
Huge.
Yeah.
$153.14 billion.
Yeah.
And the enterprise value, TTM, is $188.17 billion.
Right, so that higher enterprise value reflects their debt load. Important factor.
Good point. And the PE ratio, 19.49.
Okay.
Forward PE is a bit lower, 17.22.
Which usually suggests the market's expecting earnings to grow, right?
Exactly. That's the
Yeah,
implication.
makes sense.
Financially, let's see, last 12 months revenue was $63.26 billion.
Solid top line.
And net income, $7.94 billion.
Healthy profit.
Looking ahead, the projected EPS, earnings per share, is $18.91.
Up from the TTM.
Yeah, up from $16.27 TTM. And for dividend fans, yield is 1.73%.
Not massive, but steady.
Annual payout, $5.64 per share as of late April 2025.
Which, brings up a key question. How secure are those returns? The dividend's nice, but it really hinges on Caterpillar maintaining its competitive edge, its economic moat.
Okay, let's break down this economic moat. The analysis calls it narrow.
Narrow, okay, not wide.
Right. And it's mainly fueled by that. I mean, incredibly extensive global dealer network.
Ah, the dealer network. That's always been their strength.
Huge. Think about it. Construction, mining, you need reliable sales, service, and parts. Always parts.
Critically important, yeah. Downtime costs a fortune.
Exactly. And CAT's network delivers that. It creates, well, significant hurdles if you're thinking of switching brands.
High switching costs. If your whole fleet, your mechanics, everything is geared towards CT.
It's a massive disruption to change. Costly, too.
And, that network reinforces loyalty, reliability, access. It builds trust. Plus, you've got their sheer size, their scale, and that expanding high-margin services business. That helps lock customers in, too.
Right. The service side is key. So let's turn to recent performance, Q1 2025.
Okay, the latest number.
Sales and revenues dipped 10% year over year, came in at $14.2 billion.
A noticeable drop.
And we saw lower profit per share, too, both GAAP and adjusted compared to last year.
But.
Their adjusted operating profit and margin actually nudged slightly above what was expected.
Okay, so maybe not as bad as the headline sales number suggests. Why were sales down, though?
Good question. Main factors were lower sales volume.
Okay.
And also adjustments in dealer inventories. Seems like dealers built up a lot last year.
Ah, so the year-over-year comparison is a bit tricky then. Inventory dynamics.
Exactly. But here's the really interesting part.
Yeah.
Caterpillar reported a record $5 billion increase in their organic backlog.
Wow, okay, that's big.
Total backlog now stands at a massive $35 billion.
$35 billion, that's a huge indicator of future demand, right?
Definitely suggests strong underlying demand. And sales of machines direct to end users. Actually better than they thought.
So end user demand is holding up better than maybe the dealer channel suggests. That backlog provides a lot of visibility.
For sure. Looking ahead now, Q2 2025.
What's the outlook?
They're anticipating sales levels pretty similar to last year's Q2.
Flattish, okay.
They expect growth in energy and transportation, but that's likely offset by lower machine sales in construction and resource industries.
So a mixed picture across segments.
Yeah. And a key point, they're projecting lower adjusted operating profit margins compared to last year.
Lower margins, why?
Main reason cited is unfavorable price realization.
Unfavorable pricing, meaning they can't push price increases through as easily, or input costs are biting?
A good mix. Maybe more competition, maybe costs that they can't pass on fully. It's a headwind for margins.
Definitely something to watch.
And adding to that pressure, a significant hit from tariffs expected in Q2.
Ah, tariffs. How much?
Estimated between $250 million and $350 million. And that's after their initial mitigation efforts.
Oof. That's a substantial cost. Mitigation will be key there.
No kidding. So for the full year 2025, they gave a couple of scenarios.
Okay. Best case, worst case.
Kind of. Scenario 1, pre-tariff, sales roughly flat versus 2024. Adjusted operating margins in the top half of their target range.
Decent. And cash flow.
ME&T free cash flow also in the top half of their usual $5 billion to $10 billion target range.
Okay, so flat sales, but strong profitability and cash flow in that scenario. What's the alternative?
Alternative assumes negative economic growth in the second half.
Yeah.
Plus continued tariffs.
Tougher outlook.
Right. In that case, sales down slightly versus 2024.
Okay. Margins.
Still expected within their target range, interestingly.
Resilient margins even then.
And free cash flow, also still expected within that $5 billion to $10 billion band.
That's actually quite notable. Even in a tougher scenario, they project solid profitability and significant cash generation. Shows some underlying strength.
Yeah, it does. So key takeaways from that earnings call. That record backlog is huge for visibility.
Definitely number one.
But that unfavorable pricing is a real near-term hurdle.
Yep, margin pressure.
And the tariffs add major uncertainty and cost.
Big unknown.
On the plus side, though, diverse end markets, infrastructure, power gen, minerals.
Long-term trends supporting them.
Right. Secular trends. Strategic focus on growing services, the higher margin stuff.
Crucial for stability.
Operational discipline, strong financials, commitment to shareholder returns, dividends, buybacks.
The usual playbook for a mature industrial.
They're also investing in tech, like autonomy.
Future growth.
And expanding capacity. And the incoming CEO, Joe Creed, expected to stick to the strategy, maybe accelerate growth.
So continuity, focus on execution. Sounds like they're navigating the immediate challenges while keeping eyes on the long term. That services push is really important.
Definitely.
Okay, so what should you as a potential investor be mindful of? Concerns.
Always got to look at the risks.
Lower sales and volumes in Q1, expected lower in some segments for Q2, that's clear.
Top line for sure.
Margin pressure from that unfavorable pricing. Tariff headwinds, obviously.
Okay.
Also saw higher provisions for credit losses in their financial products arm.
Any signs of customer stress there?
They say overall customer health is reportedly strong, so maybe just prudence, but it's something noted.
Worth keeping an eye on.
And the Q1 dip in ME&T free cash flow, even though the full-year outlook is okay. Cash flow timing, maybe?
Could be. And some reported softness in oil and gas well servicing.
Okay, so mostly tied to the current macro environment and those tariffs, it seems.
Looks like it.
Yeah.
But there are definitely positive drivers too, right?
For sure. Let's balance it out.
That record backlog, we keep saying it, but it's huge.
Massive cushion.
Strong long-term trends, infrastructure, data centers needing power,
Secular tailwinds.
growing customer acceptance of their autonomous stuff,
Getting traction there.
strong demand for new large gas turbines, specifically for data centers,
Big growth area.
infrastructure spending, like the IIJA in North America,
Government support.
boosting capacity for large engines. And, management focus seems clear.
Yeah.
Profitable growth, shareholder returns.
So autonomy, data centers, infrastructure. Those look like key future growth avenues for them. Capitalizing there will be critical.
Absolutely. Finally, analyst views. Quick look.
What's the street saying?
Average price target over the last 6 months, $362.80.
A bit above the current price then. Potential upside.
Suggests some upside, yeah. And we've seen recent activity upgrades, downgrades, target adjustments from firms like Oppenheimer, Morgan Stanley, others.
The usual analyst churn. Good to know the general sentiment, but
But you got to do your own homework.
always use this info as a starting point.
Exactly. So, to kind of wrap it up, Caterpillar, facing some near-term headwinds, no doubt, pricing, tariffs,
Clear challenges right now.
but supported by that massive backlog, diverse markets, and, well, significant long-term growth drivers. This quick deep dive should give you the essential.
Captures the immediate pressures against that longer-term strategic position for a giant like Sea.
Precisely. And just a reminder, this is a starting point to get you informed quickly. Always do your own thorough research.
Yep.
And maybe consider consulting a financial advisor before making any investment decisions. If you found this concise analysis valuable, and we hope you did, and you want to stay updated on future deep dives like this,
More insights into business and finance.
make sure to subscribe to our channel and hit that bell icon.
It really helps us out.
It does. Your support helps us bring you more of these focused insights. Thanks for joining us.